Ladies and gentlemen, let me ask you something straight out of the gate. How many times have you seen panic dressed up as truth? How many times has fear been sold to you as the end? Yesterday, silver didn't just fall, it was slaughtered. Headlines screamed, charts blood red, weak hands folded. And yet, here we are today, standing above $75. Not broken, not defeated. Still standing. Because what you witnessed yesterday wasn't the death of silver, it was the cost of conviction. Markets don't move to reward comfort. They move to test belief. When silver was pushed down hard, it wasn't because its story ended. It was because pressure had to be applied. Because before a spring launches higher, it must be compressed. And that massacre everyone's talking about, that wasn't a collapse. That was a cleansing. Let's talk about why $75 matters. This level isn't just a number on a screen. It's a battlefield. It's where physical demand meets paper pressure. It's where long-term reality collides with short-term manipulation. Every time silver is driven down to this zone, buyers don't hesitate, they step in with force. Industrial users, long-term holders, and those who understand scarcity don't wait for permission. They act. That's why 75 didn't break. It absorbed the hit and pushed back. Here's the uncomfortable truth most people don't want to hear. Real wealth is built in moments of maximum doubt. When the crowd panics, value doesn't disappear, it transfers. Yesterday's sell-off shook out emotional money, leverage positions, and impatient traders. What remains today is stronger, calmer, and more intentional capital. That's not weakness. That's foundation. Silver's fundamentals didn't vanish overnight. Supply constraints didn't suddenly resolve. Industrial demand didn't take a vacation. Energy transition technology and monetary hedging didn't reverse because of one brutal trading session. What changed was sentiment, and sentiment is the most fragile thing in any market. Price may scream in the short term, but value whispers consistently over time. Understand this clearly: when a market survives a massacre and holds its ground, it sends a message, tells you that selling pressure has limits. It tells you that buyers are waiting, not hoping. It tells you that downside is being defended with conviction. $75 is not being allowed. To hold, it is being fought for. And this is where discipline separates spectators from participants. Anyone can feel confident when prices rise smoothly. But confidence forged in volatility is different. It's sharper, it's earned. Silver's bounce isn't about optimism, it's about structure. It's about real demand stepping in when paper narratives fail. Let me be clear, this doesn't mean the road ahead is easy. Volatility is the toll you pay for opportunity. Silver doesn't move politely, it never has. It shakes, it tests, it punishes impatience. But every violent move has one purpose: to force a decision. Are you reacting or are you positioning? Because history doesn't reward those who ran from chaos, it rewards those who understood it. Every major breakout, every sustained bull move, was preceded by moments that felt unbearable. Moments when conviction was mocked. Moments when holding felt lonely. Yesterday was one of those moments. Today's bounce is not noise, it's a signal. A reminder that beneath the headlines, beneath the fear, something solid is forming. Silver is not asking for belief. It's demanding respect. What looks like chaos on the surface is often discipline forming underneath. Sharp sell-offs rarely begin with a collapse in fundamentals. They begin with a collapse in confidence. When prices fall aggressively in a compressed time window, the first participants to exit are not long-term holders or industrial buyers, but leverage traders, momentum followers, and sentiment-driven capital. This distinction matters because it reframes panic selling not as evidence of structural weakness, but as a process of emotional exhaustion. The market is not breaking, it is shedding fragility. In silver's case, the recent decline unfolded with textbook characteristics of sentiment shock. Volume surged to stop, losses were triggered. Margin calls accelerated exits, and algorithmic strategies amplified downside momentum. These moves create the illusion of overwhelming selling pressure, yet they are inherently temporary. Once forced liquidation is complete, the supply of sellers rapidly diminishes. At that point, price no longer needs good news to stabilize, it simply needs the absence of fear. This is why markets often stop falling not at moments of clarity, but at moments of maximum confusion. Here's the hook: most participants miss real damage in a market occurs quietly, not violently. Fundamental deterioration reveals itself slowly through weakening demand, expanding inventories, and declining margins. None of those conditions were present during the sell-off. Instead, the decline was fast, emotional, and reactive, the signature of sentiment exhaustion. When price moves faster than underlying value can change, it is sentiment, not reality, that is being repriced. Panic selling also performs an essential economic function. It relocates ownership from participants with short time horizons to those with longer mandates and deeper conviction. Once assets move into stronger hands, the probability of continued forced selling drops dramatically. This transition is not visible in headlines, but it is visible in behavior, narrowing intraday ranges, reduced follow-through on negative news, and increasing responsiveness to buying interest. These are not signs of weakness, they are signs of stabilization. Another critical hook is this: markets do not require optimism to recover, they require balance. After sentiment reaches an extreme, even neutral positioning can support price. When fear has already been priced in, the marginal impact of additional negative information diminishes. At that stage, sellers need increasingly bad news to justify further liquidation, while buyers require only price to remain stable to step in. This asymmetry quietly shifts control. Ultimately, panic selling marks the moment when emotion outruns economics. It feels catastrophic in real time, but historically it represents the point at which downside risk begins to compress rather than expand. The absence of fundamental breakdown transforms fear from a driver into a signal, one that disciplined market participants learn to recognize, not react to. Price volatility in silver is often mistaken for a reflection of real world demand, yet the modern market structure tells a very different story. Futures contracts, options, and algorithmic trading dominate short-term price discovery, allowing large volumes of paper silver to trade hands without a single ounce ever moving. This creates rapid, sometimes violent price swings that appear disconnected from physical reality. The critical insight is that while paper markets can move price quickly, they cannot eliminate demand for a finite, tangible asset. That demand continues to operate quietly in the background, absorbing volatility rather than amplifying it. The most important hook to understand is this: paper markets can create speed, but only physical markets create floors. Industrial users cannot pause production because a chart looks weak. Manufacturers in electronics, solar, medical technology, and energy systems require consistent silver supply regardless of short-term price fluctuations. When prices fall abruptly, these participants do not retreat. They often accelerate procurement to lock in lower costs. This behavior converts paper-driven weakness into physical accumulation, limiting how far downside pressure can extend. Another layer of support comes from long-term holders who operate outside speculative timeframes. These buyers respond not to momentum, but to value relative to scarcity, replacement cost, and long-run monetary risk. For them, sharp declines triggered by paper selling represent opportunity rather than threat. As price dips, physical offtake increases, inventories tighten, and delivery demand quietly rises. None of this shows up immediately in price, but it alters the market's internal balance in meaningful ways. Here is where the disconnect becomes most revealing. Paper selling can overwhelm bids temporarily, but it cannot force physical sellers to emerge if supply is already constrained. Mine output, recycling flows, and above-ground inventories do not expand simply because futures prices fall. When physical supply is inelastic, lower prices stimulate demand far more quickly than they stimulate supply. This imbalance creates a natural stabilizing mechanism that paper markets repeatedly underestimate. The result is a recurring pattern. Sharp paper-driven declines are followed by price stabilization, not because sentiment improves, but because physical demand has done its work. As volatility subsides, futures markets are forced to re-anchor to real-world conditions. At that point, price begins to reflect what was happening all along beneath the surface. The deeper hook is that this process is not a temporary anomaly, it is structural. As industrial dependence on silver increases and available supply remains limited, the ability of paper markets to dictate sustained downside diminishes. Volatility may continue, but each episode strengthens the underlying base. Physical demand does not chase price, it waits for it. And when it steps in, it quietly redraws the boundaries of risk. Volatility is often treated as a threat, but in economic reality it functions as a sorting mechanism. When price swings accelerate, the market begins to separate capital by intention, time horizon, and resilience. Short-term, highly leveraged participants are the first to feel pressure as margin requirements rise and price moves turn against them. Their exits are not strategic decisions, they are mechanical responses. This forced behavior is precisely what drives the transfer of assets from fragile hands to stronger ones. reshaping ownership in a way that ultimately stabilizes the market. The critical hook is this: volatility does not destroy value, it redistributes it. During sharp moves, assets migrate away from participants who depend on constant price appreciation and toward those who are prepared to withstand drawdowns. This shift reduces systemic vulnerability because capital with longer mandates is less likely to liquidate under stress. Each wave of forced selling lowers future selling pressure, even if price action remains noisy in the short term. Leverage plays a central role in this process. When markets are calm, leverage appears efficient, even intelligent. When volatility rises, it becomes a liability. Small price changes suddenly carry outsized consequences, triggering margin calls and automated liquidations. These exits amplify price movement temporarily, creating the illusion of accelerating weakness. In reality, the market is performing a necessary reset by flushing out structures that cannot survive stress. Once leverage is reduced, price sensitivity to shocks declines. Another overlooked aspect is how volatility recalibrates expectations. Extended periods of low volatility encourage complacency and crowded positioning. When that equilibrium breaks, capital is forced to reassess risk, not in theory but in practice. Participants who remain after this recalibration operate with more conservative positioning and clearer risk parameters. This behavioral shift is invisible in headlines, yet it dramatically improves market durability. Volatility also attracts a different class of buyer. Institutions, strategic allocators, and value-driven participants often require dislocation to justify entry. They do not chase momentum, they wait for imbalance. Elevated volatility provides that entry window by pushing prices away from perceived fair value. As these buyers step in, liquidity improves and ownership becomes more stable. The deeper hook is that markets cannot move sustainably higher without first becoming uncomfortable. Smooth advances breed fragility, while turbulent phases build resilience. Capital reallocation through volatility is not an accident of the system, it is a feature of it. Each episode strengthens the market's foundation by aligning ownership with conviction rather than convenience. Downside risk in any commodity market is ultimately constrained by the realities of production, and silver is no exception. Prices can be pushed lower in the short term through financial pressure, but they cannot remain disconnected from the economics of supply indefinitely. When market prices approach or fall below the marginal cost of production, the system begins to resist further decline. This resistance does not appear immediately in price, but it emerges through tightening availability, delayed projects, and reduced flexibility on the supply side. A critical hook to understand is that mine supply is not elastic. Silver production is largely a byproduct of other metals such as copper, lead, and zinc, which limits the industry's ability to respond quickly to price changes. Even when prices rise, new supply takes years to materialize due to permitting, financing, and development constraints. When prices fall, however, costs do not fall at the same pace. Energy, labor, regulatory compliance, and capital expenditures remain stubbornly high, creating a natural floor beneath the market. Another overlooked factor is declining ore quality. Many of the world's largest silver producing regions are experiencing lower grades, meaning more material must be processed to extract the same amount of metal. This structural challenge raises all-in sustaining costs and increases sensitivity to price declines. When prices are pressured, producers face difficult choices: operate at thinner margins, reduce output, or delay expansion. None of these outcomes increase supply, all of them constrain it. Recycling, often cited as a potential buffer, also offers limited relief. Scrap supply responds to price incentives, but it is inconsistent and highly sensitive to economic conditions. In periods of volatility or economic uncertainty, recycling flows can decline as holders wait for better pricing or reduce discretionary selling. This further tightens available supply precisely when financial markets are attempting to push prices lower. The result is a disconnect that paper markets consistently underestimate. Financial selling can drive price faster than supply can adjust, but it cannot force new ounces into existence. As inventories tighten and future supply growth slows, the downside becomes increasingly difficult to sustain. Buyers do not need bullish headlines to recognize this imbalance. They respond to availability and cost. The deeper hook is that constrained supply does not announce itself with dramatic signals. It works quietly, reducing the market's tolerance for lower prices over time. Each episode of suppressed pricing increases the strain on production economics, making the next sell-off harder to extend. What appears as fragility on the chart often masks growing rigidity beneath the surface. Markets reveal their true character, not during calm advances, but in how they behave after stress. A sharp decline followed by rapid stabilization is not a random occurrence. It is a diagnostic signal. When aggressive selling fails to generate sustained follow-through, it suggests that the marginal seller has already exited. In economic terms, downside momentum weakens not because sentiment improves, but because selling capacity is depleted. This is one of the most reliable indicators of underlying market strength, even though it rarely feels that way in real time. The key hook lies in understanding asymmetry. After a violent drop, the market requires increasingly negative information to justify further declines, while only modest buying interest is needed to prevent additional downside. This imbalance quietly shifts control away from sellers. Price may still fluctuate, but the character of movement changes, declines become shallower, recoveries become faster, and reactions to bad news lose intensity. These are not emotional observations. They are behavioral signals rooted in market structure. Another important element is time compression. During sell-offs, price often moves faster than fundamental data can change. Demand trends, supply dynamics, and cost structures do not deteriorate overnight, yet price can overshoot as fear accelerates decision-making. When this overshoot reverses quickly, it indicates that price briefly diverged from economic reality and is now recalibrating. This recalibration phase is where longer-term repricing often begins, even if the path forward remains uneven. Resilience after decline also alters participant behavior. Traders become more cautious on the short side, reducing position sizes and tightening risk controls. Buyers, meanwhile, gain confidence that downside is being defended. This shift does not require optimism. It requires evidence that the market is refusing to break. Each failed attempt to push price lower reinforces that perception, strengthening the base without dramatic price appreciation. The deeper hook is that strong markets do not advertise themselves through smooth recoveries. They reveal strength through resistance to damage. When repeated selling efforts fail to produce new lows, the market is effectively communicating that value is being recognized at those levels. Over time, this recognition transforms volatility from a destabilizing force into a consolidating one. What appears externally as hesitation is internally a process of rebalancing. Capital adjusts, expectations reset, and price begins to reflect structure rather than emotion. In that transition, risk gradually shifts, not because fear disappears, but because it loses its power to move the market further down. So as we move forward, remember this: markets don't break strong assets easily, and they don't reward those who think short-term in a long-term game. $75 didn't just hold, it spoke. It told you that pressure has limits, that value has defenders, and that conviction still matters. The question now isn't what silver will do next. The real question is, what will you do when the next wave of fear hits? Because opportunity doesn't knock softly. It arrives disguised as chaos, and those who recognize it don't panic, they prepare. Thank you.